Hi guys, welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. Top 10 Best Investment Strategies for Long-Term Wealth Growth. So make sure to watch the full video. Achieving long-term wealth growth is a common objective for investors seeking financial security and prosperity. To attain this goal, it is essential to employ effective investment strategies that have consistently demonstrated their potential for success. The top 8 investment strategies for long-term wealth growth. These strategies encompass a range of approaches, from diversification and asset allocation to dividend investing, real estate investment, and more. By understanding and implementing these strategies, investors can position themselves for sustained growth and maximize their chances of long-term financial success. 10. Have a financial plan. A financial plan can help you figure out your risk tolerance at different points in your life as you move toward a clear retirement goal. Sticking with a sound plan can also help keep you from trying to time the market based on emotions and can help you stay disciplined, which is a key factor in long-term investing. If an investor is honest about what they want to accomplish at each phase of life, along with understanding their risk profile, the investment strategy will be designed to help them stay the course and remove the opportunity to chase investments based on emotional triggers, says Jack McGowan, CEO with 2 Point Capital Management. A financial plan will help you focus on the types of stocks and bonds in your portfolio, and whether you opt for a traditional 60/40 portfolio or you adjust that mix. Once you understand your return objective and risk tolerance, a proper asset allocation can be established, and appropriate benchmarks can be applied, says Casey Matthews, Chief Investment Officer at UMB Bank. 9. Start investing as early as possible. The longer money is invested, the more potential it has to grow. When you start early, not only do you get the compounding effects of the capital, but you also create the opportunity to buy at an average cost over time, says McGowan. Someone who contributes $1,000 a year to an IRA from ages 20 to 30 and then stops, not that stopping is a good thing, has an edge over someone who starts at 30 and invests $1,000 annually for 35 years. Assuming a 7% annualized return, the first person will have $168,515 at age 65. And the second will have $147,914. Invest early and often, says Robert Johnson, a finance professor at Creighton University. 8. Don't try to time the market. Time is your friend in the market over the long run, but you shouldn't try to time the market in the short term. It requires 2 decisions: when to get out and when to get back in, McGowan says. It's tough to get both right over time. Obsessing about getting out and back in at the right times can lead to missing out on big recovery days and can significantly lower returns for long-term investors, says Matthews. Given that the best performance days tend to be clustered among and closely after the worst performance days, staying invested through market cycles can help achieve better long-term results, says Theodore Schneider, portfolio advisor with Roundtable Wealth Management. 7. Invest in what you understand. Stay away from things that are confusing, difficult, or incomprehensible to you. If you're going to invest in a stock, make sure you understand the business, industry, and company. Many investors are attracted to companies that produce products they like and use, Johnson said, but often confuse good products with good investment opportunities. Be sure to check whether the company has a stable business and attractive prices, whether it's new restaurants or new products, friends and family raving about. However, McGowan said many investors don't have the time or expertise to understand the inconsistencies of making a particular stock a good investment in a particular market. That doesn't mean you can't invest in them. Understanding the investment process is more important because it will make that clear for every investment, he said. 6. Add 401 matches to your portfolio. There is no shortage of business ideas, but the only guaranteed risk-free house where you can get free money. However, even though many people can get a 401 through a competitive workplace, they still don't participate. Don't get like them. A 401 can provide free cash flow, structured investments, and some leverage, McGowan said. By creating your 401 or investment account, you are putting yourself and your future first. John Stoge, the founder of Verbatim Financial, recommends setting up automatic retirement savings, reaching the maximum your 401 will allow, and then adding any other investments that can be used for that brokerage account tax. You might also consider a Roth 401. Roth funds are deposited after taxes, but if you play by the rules, Roth funds will grow and be tax-free, said Ryan Johnson, Director of Management and Research at Buckingham Advisors. They may be the last to touch the money during retirement. 5. Establish and maintain effective financial management. Setting up automatic retirement is one way, but you can also use the idea of investing in the business, at least every month, in other areas. You may want to create an emergency fund in a savings account that covers 3 to 6 months of living expenses. When you commit to it, you can contribute to your 401k plan. You can set up automatic contributions to the brokerage account after they are created, or even if you start accumulating. Of course, when you do this, you have to choose where you want to spend your money each month. Do you need to sign up for 4 streaming services? 4. Set and forget with money. When you decide how much money to spend on savings and retirement versus liquid savings, you want to sit back and watch your investment grow over time. After all, you're not here for the workday. For most people, tune in and forget that it's the best long-term investment, says Stoy. One way to do this is to enter the stock market at the bottom of the fund, rather than trying to pick individual stocks. The only fund anyone needs for most of their trading life before retiring is a total stock market fund, like Vanguard's Total Stock Market ETF, ticker BTI. He said. Johnson of Creighton University says most investors should follow the wait, easy, stupid mantra. Investors cannot afford to place big bets on individual securities, he said. Trying to pick winners is a game for most people. The solution is to invest in different types of funds, and you don't have to pick winners. 3. Make products based on your ideas. Bonds are an essential part of any securities and income market. But with today's low interest rates, stocks can be your main source of income, whether in the form of interest or dividends. Some cash flow can be added to your contract, Matthews said. Many high-yield mutual funds increase their dividends each year, protecting your purchasing power. Compared to low-paying contracts, you incur inflation, which increases the cost of payments. The best way to build long-term wealth and achieve financial stability is to invest in the stock market, says Creighton's Johnson. 2. Diversification makes the road smoother. One of the best things about long-term investing is that time tends to be stagnant. You can also manage variability through diversification. In addition to diversifying your portfolio with contracts, you should also have a variety of stocks or funds in different markets and different regions. In stocks, think of stock growth against asset value. In addition to stocks and bonds, you may want to invest a small portion of your portfolio in other assets. Balance your options with a comprehensive portfolio of international and domestic stocks, bonds, cash, gold, and maybe a few cryptocurrencies, which can be a good hedge if we face a few years of inflation, said David Williver, developer of the personal finance website. Less than 30 cash. 1. Rebalance only when necessary. This last tip extends to sustainable financial planning. Even with the best planning and distribution strategies, you need to update your archive from time to time. This is different from time to time. Instead, it's a sale or purchase calculation to return your information to its original financial arrangement. Let's say you choose to go with a 60/40 portfolio, but stocks rise while bonds remain largely unchanged. This means that the original rates will not be the same. Therefore, you may need to sell some stocks or buy more bonds to restart your strategy. In the quest for long-term wealth growth, adopting the right investment strategies is crucial. By diversifying portfolios, allocating assets wisely, employing dollar-cost averaging, and embracing the buy-and-hold approach, investors can mitigate risks and benefit from market trends. Index fund investing, dividend investing, and value investing offer targeted methods for capitalizing on specific opportunities, while real estate investment provides an alternative avenue for wealth accumulation. Furthermore, maximizing contributions to retirement accounts and optimizing tax efficiency can amplify returns. By incorporating these top 10 investment strategies, investors can enhance their prospects for long-term wealth growth and secure a brighter financial future. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.